Look around you right now. Seriously, take a look. The device you're watching this on, the clothes on your back, the furniture in your room, chances are like 90% of it crossed the ocean on a colossal cargo ship. Today, we're diving into this explainer to uncover the invisible financial engine that actually keeps global trade afloat. We're going to look at exactly what happens behind the scenes when unthinkable, massive maritime disasters strike and how on earth the shipping industry manages to survive them. I mean, ask yourself, when a colossal megaship destroys a bustling harbor, or a tanker runs aground causing this unprecedented environmental catastrophe, who actually pays that massive multi-billion-dollar bill? The sheer scale of these disasters is just beyond normal comprehension. Traditional insurance companies, they simply aren't equipped to handle a sudden out-of-the-blue $3 billion payout without going completely bankrupt. So the answer lies in something called Protection and Indemnity Clubs, or P&I Clubs. Basically, these are entirely nonprofit mutual insurance associations. What this means is that ship owners literally band together and become each other's insurers to cover third-party liabilities. And by third-party liabilities, I mean the damage they accidentally cause to other people, to external property, or to the environment. It is this truly fascinating, deeply intertwined system of shared risk that keeps the whole global supply chain moving. Section 1. Birth of P&I Clubs. To truly grasp how these massive global clubs operate today, we gotta rewind a bit. So, back in late 18th century London, you had these limited proprietary markets, think giant monopolies like Lloyd's, dominating the scene. This essentially forced smaller, independent ship owners to form their own local hull clubs, just to cover basic property damage to their own ships. But then, things completely shifted. English courts suddenly started burdening ship owners with new, wildly unpredictable third-party liabilities. We're talking devastating crew injuries, cargo deviations, catastrophic collisions. Traditional hull policies absolutely refused to cover these new risks, so the clubs had to adapt. They evolved into modern indemnity clubs simply to fill this massive gap and survive. Section 2. The principle of mutuality. Now, the brilliant foundational concept making all this possible is mutuality. Imagine a huge group of friends going out to a lavish dinner, right? And they know they're going to have to split a massive, totally unpredictable dinner bill at the end of the night. That's mutuality in a nutshell. The insurer and the insured are the exact same people. The members pool their resources through what they call advance calls, kind of like a collective down payment, and then issue supplementary calls later on if more funds are urgently needed. They step up to protect each other, entirely without seeking a profit. To put this into perspective, look at the stark difference here. Fixed premium insurers offer strict, profit-driven rates with significantly lower liability limits, usually between $25 and $500 million. Great setup for smaller regional ships, for sure, but mutual P&I clubs operate strictly as nonprofits. They use that self-correcting mechanism of collecting those calls from members as needed, which lets them build a colossal, virtually unbreakable safety net for the world's absolute largest fleets, with financial limits stretching way up into the billions. Section 3. Covering unthinkable maritime risks. So what exactly goes on the shared, unpredictable dinner bill? What are these rival ship owners actually paying for? Honestly, the scope is exhausting just to think about. We're talking paying for full quarantine expenses if a highly infectious disease breaks out on board, or funding the complex logistics of repatriating stowaways and refugees found at sea. They cover monumentally costly wreck removals, life salvage, massive fines from angry customs officials. They even cover something totally bizarre called non-contact wash damage. That's literally when a massive ship is speeding, and its huge wake causes another vessel miles away to violently run aground without the two ships ever even touching. Crazy, right? They also take on 1/4 of all collision liabilities, leaving the rest to traditional hull insurers. And if something incredibly bizarre happens that isn't explicitly written on that sprawling list, well, they have the omnibus rule. This is a brilliant, discretionary sweep-up provision. Club managers can choose to cover a highly unusual claim by simply asking themselves, hey, would we have included this specific risk in our rulebook if we had just thought about it? It really highlights the cooperative, supportive spirit of these clubs. Now, that powerful discretionary rule wonderfully covers the everyday mishaps of the ocean. But it begs a massive existential question for the industry. What happens when a disaster strikes that is far too large and way too expensive for any single mutual club to handle alone, without going totally bankrupt? Section 4. Surviving billion-dollar catastrophes. See, as modern ships have grown into staggering mega vessels over the decades, the scale of catastrophes has grown right alongside them.
Think of world-halting oil spills like the Torrey Canyon, the Amoco Cadiz, or the infamous Exxon Valdez. The financial fallout was astronomical. Or consider more modern tragedies, like the Costa Concordia passenger ship disaster. That cost an estimated $750 million just to clean up. Or the MV Arena container ship grounding, which easily hit $250 million. Because of the sheer, unmitigated financial devastation of these massive events, P&I Clubs had a harsh realization. Offering unlimited coverage was simply no longer viable if they wanted to survive. So to protect the whole global system, they compromised. They put a strict $1 billion limit specifically on oil pollution claims, and that is strictly per ship per accident. For other massive catastrophes not involving oil, they capped passenger claims at $2 billion. But get this, the overall commercial reinsurance safety net that they have painstakingly built behind the scenes, that stretches up to a staggering $3.1 billion. It's a safety net of truly epic proportions.
Section 5. Paying for the disasters. Now, a really obvious question comes up here. How exactly can nonprofit mutual clubs afford to provide a mind-boggling $3.1 billion limit? This brilliantly illustrates the hidden engine I mentioned at the very start of this explainer, the international group of clubs. 15 distinct mutual clubs securely banded together to form this overarching group. Together, they represent a massive, frankly unbelievable, 90% of the entire world's ocean-going tonnage. By creating this giant, globally interconnected pool, they can safely share the immense financial burden of these apocalyptic catastrophes. Let's meticulously guide you through how they structure this financial risk. It's quite literally built like a staircase. Step 1. The individual club handles the first $10 million of a claim entirely on their own. Step 2. If the disaster exceeds that, the group pool and their captive reinsurance vehicle, Hydra, take the hit up to $100 million. Step 3. For true mega disasters, they go to the open excess loss reinsurance market, covering them up to $3.1 billion. And if a disaster goes beyond that unimaginable number, Step 4 is triggered, a collective overspill call, where every single member club across the globe have to desperately chip in to cover the excess.
So here's the crucial point to understand. There is a major, terrifying catch for the ship owner in all of this. Under the strict pay-to-be-paid rule, which was heavily challenged but ultimately upheld by the English courts, a member must actually discharge their liabilities first, meaning they have to physically pay the multi-million-dollar claim out of their own pocket before the club will reimburse them. For a shipping company, that is an absolute massive cash flow nightmare.
That naturally sounds terrifying for any business owner facing a giant claim, right? But the clubs do provide a vital, stress-relieving lifeline called a letter of undertaking, or an LOU. This acts as a formal, legally binding guarantee from the club itself. It absolutely ensures that a member's ship isn't literally arrested by angry port authorities and indefinitely held hostage while a complex, multi-year claim is being investigated and settled. So we've seen exactly how fierce rival ship owners have banded together since the 18th century to share the highly unpredictable risks of a perilous ocean. By relying entirely on the unique power of mutuality, they've built an invisible, multi-billion-dollar safety net protecting the entire world's economy. But as modern vessels continue to grow into massive, floating cities, you really have to wonder, will this cooperative, centuries-old financial engine hold up under the extreme pressure of tomorrow's mega catastrophes? It's definitely a fascinating, lingering question to consider the next time you see a colossal cargo ship on the horizon. Thanks for joining me on this explainer.